Everyone wants to live an inspired life, yet so many people search for happiness following the footsteps of peers and taking advice from people who have different values and outcomes to which they're searching. There are people born into wealth, graduated from the best universities in the world, and there are people who have none of that and yet are living extraordinary lives full of fulfillment and reward. The purpose of this podcast is to share insights and strategies that allow you to question the status quo and think freely, so you can design your life and be who you want to be. We get one life. Time is our most valuable asset. I believe that when we're free and able to focus on meaningful work, we become better human beings. This is Always Free, and I'm your host, Jason Graystone.
Welcome to the leading podcast for financial empowerment and wealth creation. Subscribe to this podcast so you don't miss an episode. You can connect with Jason on social media and subscribe to the Jason Graystone YouTube channel for weekly videos. Don't forget to also subscribe to the weekly newsletter to receive frequent educational content and action steps to help you design your life so you can be who you want to be. For news on all future events and updates, go to jasongraystone.com.
Well, welcome back to the podcast, guys. I hope you've all had a good week. If you're listening to this for the first time, as always, I want to let you know that you are in the number one place for financial empowerment and true wealth creation. No fluff here. And if it's the first time you're listening, go back and listen to the other episodes. I say it every single week. It's really important that if you got value from this one or the last one, go back and listen to episode 1 because you really will get maximum value that way. This week I wanted to talk a bit about your living expenses. And I'm not talking kind of physiological living expenses. I'm talking about lifestyle. Okay, so essentially your luxuries, the things that you want to buy, because I'm a true believer that you can have it all. You see these kind of people scrimping by and they might have a load of cash in the bank, but they haven't really lived. They're very disempowered because they haven't got the things they want, and they end up they're the kind of people that are pushed around made to believe that a stitch in time saves 9 and you've got to save a penny and the pounds look after themselves and all that kind of stuff, and they save coupons and the rest of it. And what happens is they end up very disempowered and they don't have the lifestyle. So by the time they get to 40, 50 years old, they end up rebelling and having a complete midlife crisis, and they go and do the things that they want to do. I'm a believer that you can grow your lifestyle and your luxuries with your growth, with your income, but you just have to do it the right way. So I have a very, very strict formula for that, and I want to share that with you in this episode. So like everything with this podcast and everything that I always preach about, it's always about freedom. The objective is freedom, freeing up time. So I'm going to introduce to you my freedom formula. And this is kind of my freedom formula for lifestyle growth. And if you follow the principles that I'm about to share with you, I promise that you can have an amazing life in terms of lifestyle scale. So the freedom formula basically spells out freedom, and I'll take you through what the FREEDOM stand for. So first things is F for fair exchange. If you're talking about things that you want to have and money you want to earn, and everything's focused on you and what you can have and what you can do, you need to understand that, and I've said this before, that you have to have a bigger reason to want to serve people. If you're learning to trade, then you've got to have a reason beyond you so you know how to give back later, because you're going to want to give back later. Once you become a trader, if you're trading full time, there's going to be an urge inside of you to go and do something bigger, serve. And how can you expect to sustainably earn lots of money and have nice things if you're kind of not prepared to give an equal proportion of output to the world? It doesn't work like that. But on the other hand, don't be afraid to charge well for your time. Those who give more get more. And if you're serving and you have a greater cause beyond yourself and you're going out there and kind of changing people's lives, then you should be rewarded for that. Don't be one of these people who kind of starts a business and gets imposter syndrome and starts giving discounts to all your friends and kind of giving freebies to all your friends, because they'll just take you for a ride. But what I'm getting at with the fair exchange is you can't just expect for some $1 million check to show up in the post box for doing nothing. And we can't expect to live an inspired life without serving humans, serving humanity and serving the world in some way that's equal to our reward. That's just not real. It's not realistic. If you go back to my podcast interview with Dr. John DiMartini, he mentions this scenario in a business dynamic, and he talks about the importance of being neutral and being in equilibrium with your clients. So go and listen to episode 28 if you haven't already. The next thing is rate of growth. Okay, so the rate of your lifestyle growth wants to be gradual and steady and consistent. It's not really it's not really a goal, or you don't really have a target in this. It's just actually a habit. It's something that you just have to work on and make sure that it's consistent and steady and it's growing sustainably and gradually. And there'll be times that you need to reward yourself, and there'll be times that you kind of knuckle down, and it's about having regular rewards every now and then and stretching yourself to taste the next level. But you don't want to be stagnating, okay? You want to be growing. And in order for that to be sustainable, it needs to be done in a way that's manageable and inspiring to you. I know millionaires who've got tons of money in the bank, but then they scrimp and they save and they never reward themselves, and people get burnt out like that. And I also know people who have no money, but they go way above their means and they think that they can have too much. And I see kind of these oscillations in income and debt. They gain it all and lose it all. They have a good month at work and they go and splurge it, or a good year. They go and have some lavish holiday or lavish car, and then they get in debt and they have to go and sell it all. And kind of all these oscillations, in income and debt. They gain it all, lose it all. If you're growing income, you should have a plan for treats. Work on you first. Set your calendar up for breaks. Put yourself in the calendar first, your family in the calendar first, and do you. It doesn't have to be materialistic. It can be kind of just a break away. It can be a little, a safari, whatever, right? Whatever it is that you like doing, put that in the calendar and plan those little breaks. But make sure it's sustainable and within the means. What I will say about that, though, in terms of lifestyle scale, is don't expect too much too soon. It's a bit like losing weight. Right? You shouldn't expect to lose weight. If you're doing a calorie deficit or something, you don't really see many results in the first 2-3 weeks. And then there's this kind of exponential result in the latter part of the journey. And it's the same with lifestyle growth. So the next thing is expectations and visualizations. So I work with a lot of traders, and the hardest thing for them to comprehend is what the future looks like. Being able to have a tangible graph or diagram that allows them to have solid expectations of what their future looks like. And when you do have that, it allows you to remain focused on the mission. And with the traders, it gives them encouragement and a level of certainty of achieving their goals. And what I'm talking about here is simply knowing your numbers. Having a projection, having a forecast on what you need to be earning to get certain things, and when you're likely to get there, and what your life looks like, and what your purchases are. So getting clear and visualizing what your lifestyle goals look like, what they feel like, what they smell like, what they taste like. And by having a graphical representation of what your goals look like, it doesn't only significantly enhance your chances of achieving them, but it'll also stop those momentary splurges, that desire to go and spunk a load of cash. And instead, it's planned. And of course, whatever we plan, we get, as you know. I've been over that before. And what I will say here, actually, a bit like losing weight as well, if you do have a little urge, and that little voice inside of your head is saying, treat yourself, and it's a bit above what you feel like you want or you can afford, because that happens when you feel frivolous. You've got this little voice inside your head telling you, persuading you why it's a good reason to buy something. Give that little thing a name. Give that voice a name. And I'd love to hear what you call it. Call it Eric or Splurgy Sharon or, something like that, where you can just give it a name and tell it to shut up. The next one is expenses to assets. So remember, I've spoken about this before, and I've spoken about the leveraged income that comes from investment returns. And remember, I mentioned that whilst you're fit and healthy and young and you're able to just compound that and you don't have to live off of that, you want to be able to switch off those leveraged income streams. So many people listening to this will not be generating leveraged income or passive income streams yet, at least until they get a bit further down the line. So leveraged income's irrelevant when we're talking about lifestyle growth for now, but what we're talking about is your savings and your expenses. So your cash and your living expenses. So the ratio between your buffer, your savings, your liquidity, and your car and your fancy clothes and your holidays and your lifestyle. And depending on that ratio will determine how you feel the balance between your freedom and your outgoings. So as a rule of thumb, I always say you only increase your lifestyle expenses if you can increase your savings by the same amount. There was something Jay-Z said where he said, if you can't afford to buy it twice, you can't afford it. And what that means is you need to keep the relative balance between your freedom and your lifestyle. So if you're paying £300 a month for a car and you fancy an upgrade, and the upgrade's going to cost £600 per month, well, that's a £300 uplift. So only go and do that if you can raise your savings by another £300. So in other words, you've got to go out and be earning another £600 per month to do that upgrade. And that's without tax. If your tax is 30%, then there's a multiplier of 2.6, and you need to increase that, increase your income by 2.6 times the total debt. So if you can't do that, consider getting a cheaper car or meet in the middle. What you don't want to do is go and get a promotion or a raise at your job and then go and spunk the lot on an upgrade of a car whilst paying yourself or your freedom account absolutely nothing extra. And when I got rid of my car, I got rid of my A7 when we moved house because we were minimalising everything, and because we were juggling a lot of money around, I started to analyse what we were doing, what we were spending, so I could reallocate some funds to investment accounts and other ventures. And I immediately saved 17 grand per year on the MOT, the service, the fuel, the parking, the wheels, the repairs, the insurance, and all that kind of stuff. And when we moved into our new house here, there's only 2 developments on this farm where I live, and the neighbours might look at me and think, oh, he hasn't even got a car, But what you have to remember is they're going to work every day. They get up as early as me, and they go out, and they don't come home until very, very late when it's dark, and they're literally never there. I don't even think we've seen them home. But they must see me every day swanning around in my shorts and kind of not leaving the house and doing whatever I want every day. And they probably think I'm a drug dealer. But it's not. It's because I carefully weigh up my expenses to assets whenever shifting money around, so I can take a broader view on it. And I value time and wealth. That always comes first. So when I do go to get my next car, which I'm looking at the moment, I'm in the market for at the moment, I'll use all of these freedom principles, and they'll all be taken into account, and they'll be logged in the lifestyle scale tool, which we've developed inside the Tiers of Freedom platform, and I'll be weighing all this stuff up. And that brings us to the next one, which is debt to income. Okay, so your DTI ratio, which I've been over before, is simply a way of calculating whether or not your lifestyle is getting out of control. So you need to keep tabs on this. It's really important. And the score will dictate how poor you feel, okay, or how abundant you feel. And you already know what this is because I've explained it in previous episodes, but it's simply your total monthly debt repayments divided by your total monthly income, and that's it. So if you have some cards, store cards, loans, and that totals £1,000 and your income's £2,000, well then your DTI is 50%. And that's quite high. Ideally, you want to be below 20, but absolutely minimum, get it below 40%. And many lending institutions have a limit of around 36 to 40%. So if you're above 36, then they won't lend you any more money. So that's really handy to know. Your DTI is really handy to know in that way. But don't do all that pretender spender stuff. Don't buy stuff and sacrifice your own mental health. It's just not worth it. The great thing about the DTI is it gives you objective rules and guidelines around your own debt and income, which is correlated to it's literally directly correlated to your well-being. You don't want to just make it up as you go along and, not know what you're doing, have a good year in business and go and splurge beyond your DTI guidelines. If you're getting up to 100% DTI, which in a lot of countries they do, then you're literally just a slave to debts. You're a slave to the debt, and you're going to work literally to pay the debts, and you're basically a slave to the economy. So my advice on that is to absolutely get below 40%, but 20% ideally. So the 6th one is O, and that stands for other people's money. And you've heard Kiyosaki say this, and you've also heard people say, oh, but you shouldn't get debts. Well, there's good debts and bad debts, okay? And what I see is a lot of particularly middle-class people with this massive pride of ownership thing. They save and save and save and save and save until they've got a ton of liquidity, right? Cash or freedom. And then they go and blow it on something that locks it all up. Whatever they've bought, they've just dumped the cash into, and it's like freezing a tap. Freezing a tap. Imagine drinking from a tap and then you freeze it and you just get these little drips and then it freezes and you get no more water from the tap. So at that point, they've then got to go to work to pay for the upkeep on what they've bought. If you go and invest it into the market, in the stock market, and you put your money to work, and let's just say that you're investing at 7%, 8% per annum, you could go and get a 4% finance on a car, right? My Audi was 4% APR. So why would you sacrifice a return of 8% and not pay 4%? The only people that do that are people who don't invest in the markets, don't build wealth, they don't, have time as their highest value. They don't know what they're doing. And there'll be people who say, oh yeah, look at Jason, that Audi he drives isn't really his, he doesn't own it, he finances it. And make no mistake, I could have just simply withdrawn from my investment account or my cash buffer account and taken 70 or 80 grand down to Audi and bought the car. But the markets have been doing incredibly well for the last few years, and they've actually hit record highs. You've seen in the news lately, the S&P hit record highs this year. So just to do some quick maths, if my car with all the mods and everything was 80 grand, the interest repayments would be about 3 grand per year. So over a 3-year term, that would be 9 grand. Now, the last couple of years, I've had a 12% return on my passive investment account, which if I had used that as to pay for the car, right, that would have given me a £9,600 per year income, or 30 grand almost over the 3 years. So why the hell would I sacrifice a 30 grand income instead of just paying 9 grand? It doesn't make sense. Plus I'd feel poor and my animal brain would kick in and, I'd be depleting my buffers and I'd be going crazy. So the key is don't use your own money if you don't have to, okay? As long as you're controlling your DTI, you're good to go using other people's money. And finally, the 7th one is M, and that stands for minimum splurge. So basically this is a caveat. It's kind of a rule that says you can ignore using other people's money if you are buying something and the purchase is going to cost less than 1% of your entire liquidity. So there's going to be times when you want to buy something, and although you're managing your money wisely and using other people's money and investing, there's going to be times where you hit a threshold of where the time that you have to invest in actually arranging that loan or debt, it will just outweigh just paying for it. It just won't make sense in terms of your time to do it, because your time will be worth more. So usually, as a rule of thumb, this is when you have 100 times more than what the thing's worth. So look, if you wanted to buy a 5 grand watch in cash, it would be wise to only buy it when you have 500 grand in the bank. If you want a £1,000 handbag, don't use other people's money if you have 100 grand in the bank. But on the other hand, if you wanted a 250 grand Lamborghini and you've got 5 million in the bank, that's 5% of your total liquidity gone, just like that, down the drain and depreciating. That's a fair whack of your investment return. So you're better off getting the finance in that situation and using the rest of these principles. And remember, I'm only talking to people who are investing and basically building wealth. If you've got 500 grand and you want to buy a £1,000 handbag and you're not investing and you're not getting good returns, then yeah, just buy it. I'm talking to people who are smart money and are building wealth. So those are my freedom guidelines of lifestyle growth. Hope you enjoyed it. If you got value from this, please share this podcast around, okay? And please leave me a review, because the reviews keep me going. I love seeing the reviews. I read them all personally, and they keep reinforcing that I'm providing value to people, and I want to keep spreading this message around. I worked out that if one person shares this to 3 people per week, and then they share it, and they share it, and they share it, after a year, I have 67,000 people that the message would have reached. But in just under 2 generations, which is about 50 years, we're going to be reaching over 7 billion people. Okay, so really important that you share it if you got value. I believe that everyone needs to hear these messages. And until next week, have a great rest of your day and weekend, and I'll see you then.
Subscribe to this podcast so you don't miss an episode. For news on all future events and updates, go to jasongraystone.com.